Hello again, it's Dr. Trussell here. We finished up talking about assets, and now we're going to be moving on to talking about how to account for, report, and analyze liabilities. So in this chapter, we'll talk about current liabilities, bonds and long-term liabilities, how to account for bond issues, how to account for bond redemptions, that is payoffs, and how do we analyze the financial statements related to liabilities. First of all, you might recall that we have talked about the difference between a current liability and a long-term liability. A current liability has two features. The company expects to pay the debt from existing current assets or the creation of other current liabilities. And the company will pay the debt within 1 year or the operating cycle, whichever is longer. Current liabilities include notes payable, accounts payable, unearned revenues, and accrued liabilities like taxes payable, salaries payable, wages payable, interest payable. All of those are considered current liabilities. Sort of a working definition is those liabilities, those things that you owe within 1 year, is sort of a good working definition. To be classified as a current liability, a debt must be expected to be paid, both A and B, out of existing current assets, such as cash, for example, or creating other current liabilities. Notes payable, well, we talked a little bit before. You might remember talking about accounts receivable and notes receivable. It's very similar. We have notes payable and accounts payable. So notes payable is just more formal. It's a written promissory note. Say we borrow money from a bank and you owe it back, usually with interest. And those due within 1 year are typically classified as current liabilities. Otherwise, if they're due more, say 5 years, 10 years, then they're going to be a non-current or long-term liability. First National Bank agrees to lend $100,000 on September 1st, 2014 if Cole Williams Company signs a $100,000 12% 4-month note maturing on January 1. That would be January 1, 2015. They didn't make that clear, but because it's a 4-month note, it does make sense. When a company issues an interest-bearing note, the amount of assets it received generally equals the note's face value. So we got cash, and we have, so remember that debits increase assets and credits increase liabilities. If coal company prepares its financial statements annually, then it needs to make adjusting entries at December 31st to recognize interest. So we're going to have interest expense, which remember is the principal or the face times the interest rate times the number of months out of the year. So 4 months out of 12 months, we're accruing interest for September, October, November, December, 4 months. And we're not paying it yet, so therefore we have to credit interest payable. That just means it will be paid. Then the next day, which we call the maturity date, January 1, 2015, they must pay the face value of the note including interest. So the face value of the note, which is the amount you borrowed, and the interest that you accrued on December 31st is going to be paid in cash. So those two liabilities are being reduced and your asset cash is being reduced. Sales taxes payable. When you buy something in a store, a company charges you sales taxes. Well, they're collecting the taxes from you, but then they have to remit it to the State Department of Revenue. So March 25th, cash register readings show sales of 10,000 and sales taxes of $600, which means it's a sales tax rate of 6%. How do they record that? Remember, they're collecting the cash, including sales tax, but only 10,000 of that is revenue. The rest you owe Uncle Sam. Now that's not always paid right away, so you have to say sales taxes payable. Sometimes companies don't ring up sales tax separately on the cash register, meaning that they just, they'll take the money from you but not necessarily have it separated out. So if they ring up total receipts of 10,600, because the amount received from the sale is equal to the sales price 100% plus 6% of sales, then the journal entry is the same as we made, but you have to compute the revenue. Now how do we do that? We take the total cash receipt and divide it by 1.06. Now what is that? That is the same thing as 100% plus 6%, 106%, which is the same thing as 1.06, and then that will get you back to your sales revenue. Unearned revenues are revenues that are received before the company delivers the goods or provides a service. So for example, you let's say that you're an attorney and you collect fees up front. Well, you owe them the service, the legal services. So the company debits cash but credits a current liability called unearned revenue. It's not a revenue, even though it has this title, revenue in the account. It's not considered a revenue because it's unearned, meaning that you haven't provided the service yet. When they do provide the service, they earn the revenue, then they debit that liability and credit the revenue account. Superior University sells 10,000 season football tickets at $50 each for its first 5-game home schedule. The entry for sales of season tickets is, well, 10,000 football tickets at $50 each. And notice we do not put it into revenue, but unearned. This is a liability. It gets a lot of people confused, but that's a liability because we owe them the service. That is, we owe them the football games. After each game is completed, then we have to record we've earned the revenue at that point. So we reduce the liability, not the whole amount, just what we've earned, and then we recognize the revenue. So remember, this is a liability, this is a revenue account. Current maturities of long-term debt. It's the portion of long-term debt that comes due in the current year. No adjusting entries required. Well, think of it this way. You borrowed some money from a bank, let's say, as a car loan. Some of that car loan is due, and say it's a 5-year loan. Some of that is due next year, and some of it is due in years 2 through 5. The amount that's due next year is a current liability, even though it's all part of the same loan. Here's an example. Wendy Construction issues a 5-year interest-bearing $25,000 note January 1st, 2011. This note specifies that each January 1st, starting January 1st, 2012, they should pay $5,000 of the note. When the company prepares its statements, what are we going to do? What should be reported as a current liability at December 31st, 2011? Well, what do we owe? Only 1 year at that point. And the rest of the $25,000 is a long-term liability. So we're just splitting the total liability of $25,000. We're splitting it into 2 pieces. What's due next year or within a year, and what's due after a year. Payroll and payroll taxes. The term payroll pertains both to salaries which are managerial, administrative, sales personnel, and wages, which would be store clerks. They're paid normally by the hour. So there's a salary, a monthly or yearly salary versus a hourly rate. Determining payroll involves computing three amounts: gross earnings, which is the total salary or wages you've earned; payroll deductions, which is the amount they take out of your paycheck for things like Social Security taxes; and the difference is your net pay. That's the check that the employee would receive. That's the check amount. Assume Cargo Corporation records its payroll for the week of March 7th as follows. So what is going on here? The wages expense, which would be your gross pay, what you've actually earned, where the wages payable, that is the check that they're going to eventually write. And then these other three items are deductions from your paycheck. FICA payable, which is Social Security. Federal income tax is the tax that's owed to the federal government. And then state income tax, the tax that's owed to the state. And then we go and pay it, and that salaries payable is now paid. This is the actual check amount. So the difference between the check amount, this is the net pay here. That's your net pay. No, it doesn't look like a net, but that's what that is. That's your net pay. Payroll tax expense results from three taxes that the government levies on employers. So this is not something that employees pay. That was the previous slide. This is something employers pay. So actually employees are expensive because not only do you have to pay their payroll, their net pay, but you also have to pay these three things, which are FICA, which is Social Security. Both you and the employer pays that. Federal unemployment tax and state unemployment tax. That's people that receive unemployment. That money goes to fund that. So here's an example. Based on Cargo Corporation's $100,000 payroll, the company would record the employers, not the employees, the employers' expense as follows. Payroll tax expense, and then it's all related to FICA, Social Security, state unemployment tax, and federal unemployment tax. So not only do they have to pay the payroll, they also have to pay all these other expenses related to it. Employer payroll taxes do not include. Well, there were only three things, and we know that there was Social Security, federal unemployment, state unemployment, so that left us with federal income taxes. The employer doesn't pay that, the employee pays that. Bonds. Bonds are a form of interest-bearing notes payable issued by corporations, universities, governmental agencies, nonprofits, all different kinds of organizations, but they are a form of notes payable. They're sold in small denominations, usually around $1,000. And when a corporation issues the bonds, it's actually borrowing money. It's just like a note, just like a note's payable. The person who buys the bond is called the bondholder. They're investing in bonds. Another way of saying that they are loaning money to the company. And there are different types of bonds out there. One is secured, meaning it's backed by something like a building. Unsecured means it's not backed by anything. There's no collateral. Convertible means that they can convert the bond into common stock. And callable means the company can buy back the bonds at a specified price. Let's talk about issuing bonds, or it's also called selling bonds. On the bond itself, it's called the bond certificate. It's issued to the investor or the bondholder. it provides the name of the company issuing the bonds, the face value, which is like its principal, the maturity date when it's due, and the contractual or stated rate, which is the amount of interest that you have to pay periodically. The face value, again, is the principal. Maturity date is when it's the final payments due, and the contractual rate is the rate to use to compute the payment. And here's an example of a bond certificate. You can see who issued the bond, the maturity date when it's due, the contractual rate, how much interest it's paying, and the face value or the par value, which is $5,000. The market value, which is the present value or the what the bond is worth on a given day. How do you figure out how much the bond is worth? It's a function of three factors. The dollar amount to be received, which is like the face value, the length of time until the amounts are received, which is the term, is it 5 years, 10 years, and the market rate of interest, that is what the other similar bonds are paying out in the market. The process of finding the present value is referred to as discounting the future amounts. Assume that Acropolis Company on January 1st, 2014 issues $100,000 of 9% bonds due in 5 years with the interest payable at the end of each year. So here's an example of the time diagram representing the cash flows. 0 is today, January 1st, 2014, and at the end of every year they're going to pay the interest. Well, how is the interest determined? Remember, we take the face value, $100,000, times the stated rate, 9%, times 1 because it's an annual payment. That's where the $9,000 came from, and it's due at the end of every year. So all those payments are due, and at the end of the 5th year, the principal or face value is also due. So to determine the price of the bond, we take the present value of the $100,000, what's it worth today, taking out interest for 5 years, and add in the present value of this $9,000 that's received every year for 5 years, and add them together, and the market price is, in this case, the same as the face value, but it does not have to be that way. A corporation records bond transactions when it issues or retires, that is, buys back bonds, and when the bondholders convert bonds into common stock. Bonds may be issued at face value, like we saw in the previous slide. It may be issued or sold below the face value, which is called issued at a discount, or you can sell them at a higher price, which means at a premium. Bond prices are quoted as a percentage of the face value, like 98%, 102%, etc. The rate of interest investors demand for loaning funds to the corporation is called what? Well, that's called the market interest rate, because the investors are going to demand that a company pays whatever the market pays. They don't care what it lists on the bond itself, they want the market rate. DeVore Corporation issues 100 5-year 10% $1,000 bonds dated January 1st at 100. Now remember, this means 100% of the face value. The entry record the sale is. It's kind of like issuing a note payable, except we're issuing a bonds payable. You're still borrowing money. And where did we get the $100,000? It is 100 of these $1,000 bonds, so just 100 times 1,000. Now at December 31st, we're going to accrue interest for an entire year. So it's still that formula, face value times the contractual rate times time out of 12. How many months out of 12? And so we have interest expense and interest payable because we're not paying it until the 1st. What would they make on January 1st of the next period? Well, we just accrued the interest and we have to pay the cash. The question is the bond issued at a par, at discount, or premium? If the contractual rate is 10%, now that's what we promised to pay them, but the market rate is 8%, then the bonds will sell at a premium. That's because what we're paying is 10% is greater than the 8% that the market's paying. So everybody's going to want to buy our bonds, which drives up the price. If the contractual rate's 10% and the market rate is 10%, then it's going to sell at face value. There's no discount or premium. You're paying exactly what the market is paying. However, if the market rate is 12%, which means the contractual rate is less than the market, well, nobody's going to want to buy our bonds unless we discount the price to match what the bond is paying. Carson Inc. issues 10-year bonds with a maturity value of $200,000. If the bonds are issued at a premium, this indicates what? Well, we know if the bonds that are issued are a premium, we're paying more than the market is paying. So that must mean that what we're paying, the contractual rate, exceeds what the market is paying, which is A. Assume that January 1st, 2014, Candlestick sells $100,000 of 5-year 10% bonds at 98. Remember, that means 98% of the face value, which was $100,000. With interest payable January 1. The entry to record the issuance is, well, again, it's like borrowing money from a bank, but this time what we received was actually less than what we're going to pay back, so therefore we have what's called a discount. We're selling the bonds below the face value, so they sell at a discount. And on the balance sheet, it would look like this. We take the bonds, we subtract out the discount, and we get back to that $98,000 price. Discount on bonds payable is what? It is called a contra account or a contra liability because it has the opposite balance, or it's subtracted from the account to which it relates, which is the bonds payable. Assume that Candlestick previous bonds sell at 102 rather than 98. Remember, that means 102% or 1.02 times 100,000. Well, now it's going to sell at a premium. So we actually sold the bonds above the face value, so they're sold at a premium. And the premium is actually added to the bonds. Redeeming, which means paying off the bonds. When the bonds are due, it's a pretty straightforward, just like paying off your note, you have to remove the bond and pay the cash. When a company retires the bonds before maturity, it's a little bit different. Before maturity, you have to take the carrying value of the bonds, figure it out, and remove it from the books, record the cash paid. But one step that we didn't have in the previous slide, we're going to have a gain or loss. Why? Because the carrying amount of the bonds, or the book value, is different from what it costs to pay off the bonds. So therefore we'll have a gain or loss. When bonds are redeemed before maturity, the gain or loss redemption is the difference between the cash paid and what? Well, we know it's the carrying value or the book value of the bonds. Assume at the end of the fourth period, Candlestick, having sold its bonds at a premium, retires the bonds at 103 after paying annual interest. Assume that the carrying value of the bonds at redemption is $100,400. Principal $100,000, premium $400. Candlesticks records the redemption at the end of the fourth period as follows. Well, what we're going to have to do is remove both the principal and the premium and record the cash price of 103. So remove the principal, remove the premium, record the 103 times 100,000 cash amount, and the difference is going to be a loss. Since it's a debit, it is a loss. Had it been a credit, it would have been, had it been over here a credit, that would have been a gain. But since we needed a debit to balance it out, it's a loss. When bonds are converted into common stock, the carrying value of the bonds is transferred to the paid-in capital. In other words, whatever look on the books of the bonds is moved into the paid-in capital accounts or the stock accounts. And you can kind of get an overview of what it looks like on the balance sheet for our liabilities. So we have broken down between current liabilities, such as notes, accounts payable, current maturities, accrued liabilities like wages liability, and then wages payable, and we have long-term liabilities like bonds, notes, leases. Those are long-term, due more than a year. Well, let's talk about how do we analyze the financial statements. For example, if we look at Toyota, what they have is these are balance sheets. Here are the total assets for the period. Here are total liabilities, but notice we break it into current and non-current, and so that's going to help us analyze or say, well, is the company doing better or worse? It's hard to look at all these numbers and say, well, are they improving? Are they about the same? So we have some ratios to help us. One thing we want to do is look at liquidity ratios. We've seen these before. The current ratio, which is current assets divided by current liabilities, and it shows you what's your state based on your current assets and current liabilities, and we want it to be well above 1. And so you'll notice that Toyota looks pretty good. Although they went down in 2011, they're still better than the industry average, which is 1:1. Another ratio, set of ratios called solvency, and that's your ability to pay your long-term debts. And we have the debt to asset ratio, total liabilities over total assets, and then we have called times interest earned. How many times do you earn your interest during the year? And you'll see that Toyota, their debt to asset ratio is hovering in the low 40s, but the industry average is 62%. So they have much less debt than the rest of the industry, and that is a good sign. Times interest earned, you want a higher number is better, and they did really well in 2011. 2010, they were about where the industry is. Let's talk about amortizing. Amortizing a bond discount just means writing it off. We have to write it off over the number of periods, interest periods. So we take our bond discount divided by the number of interest periods, and that gets how much. Now this is a write-off. How much of the bond we're going to write off or reduce during the period. Candlestick Inc. sold 100,000 5-year 10% bonds for $98,000. Now this is the same example we had earlier, but they want you to not do the initial entry, but what the entry to accrue interest in December. And that is, first of all, we're going to take our 100,000 times 10% times 12/12 is how we're going to get our interest payable. The discount on the bonds is going to be the original 2,000 discount divided by the 5-year period gives us 400. All right, how do we prepare what's called an amortization table? This is just to keep track of all your write-offs. So we know that we had the interest paid. We already showed you how to do that. And then the discount amortization, we showed you how to do that, 2,000 divided by 5. The interest expense is just adding those two numbers together. And the unamortized discount is just your beginning minus what you wrote off this period to give you the ending number. And then your carrying value is just your $100,000 minus the unamortized discount. 100,000 minus your unamortized discount. So this is the same example except with the premium, the $102,000 issue price. The entry to accrue interest from the amortization table, you just pull off the numbers from there and you see that the interest expense is $9,600, the premium which is debited to amortize it, and the interest payable $10,000. And the bond amortization schedule, when it's a premium, looks just like the discount one with one exception. That's the last column here, and then instead of subtracting, we add. So you take 100,000 plus 100,000 plus. So otherwise it's exactly the same. That's what we call the straight line method. There's another method of amortizing the discount. It's called the effective interest method. And it's a little bit different. We compute the bond interest expense first instead of third, and then the interest paid, and then the amortization. And so the formula is your bond carrying amount, the beginning, times the effective rate, then minus the face value times the contract rate. So we're going back to the initial example when we sold the bonds at 98,000, and they're telling you that the effective rate, which is the same thing as the market rate, is 10.53. So what's it look like? Well, the difference is that column A does not change. That's still the payment. What changes is column B. Column B is going to be the carrying value, the beginning carrying value times the effective rate. All right, so the beginning carrying value for the first period is 98,000, which is right here, times the effective rate gives you the interest. Then take the difference between those two columns. The difference between these two gives you that. After that's the same. So it's just the difference is column B, how to prepare column B. So to record the interest accrual using that amortization schedule, this is right off of that schedule, is we take the interest payable right off the column B, column C is for the interest expense, and then the difference between them is your discount, the reduction or your amortization of the discount. Let's do the same thing for the 102,000 for the premium example. The amortization schedule is the same, done the same way. we take the beginning carrying amount of 102, multiply it by the effective rate, which is given at 9.48. That's going to give you your interest. Then take the difference between the interest to be paid and the interest expense, gives you your premium amortization. Then after that, the table is the same. So what does it look like in the journal entry? Very similar, except we debit the premium rather than crediting the discount. Long-term notes payable are very much like long-term bonds payable, and they may be secured by a mortgage that pledges title to specific assets as security or collateral for a loan. So if you borrow money to buy your house, that's what we're talking about. You have a mortgage. And when you make a payment, it's a little bit different than the bond. The bond payment is only interest. With a mortgage payment, you have interest and principal in each payment. So it's a little bit different than the previous examples. If we issue a $5,000, 12%, 20-year mortgage, and the payments are $33,231, well, they're giving you now this amortization table is just like the previous one, with the difference is the cash payment is given. Then you compute the interest expense. Remember, we did that before, which is column D times your 6%. Now why 6%? Because it's semi-annual installments, and 12%, your interest rate is 12%. So if it's semi-annual, 12 divided by 2 is 6. So what are the journal entries? Record the mortgage loan and the first installment payment. Well, the mortgage loan is just like a note payable. We just call it a mortgage payable. Then the interest, which is the interest expense, like we saw in the previous slide, and the cash was given. So this just comes off the amortization table. All those numbers come right off of there. Each payment on a mortgage note payable consists of interest on the unpaid balance and a reduction of the loan principal. In other words, principal plus interest. Well, let's look at IFRS and see the difference. Under IFRS, companies will net current liabilities against current assets and they call that working capital, just the difference between current assets and current liabilities. IFRS also requires the use of the effective interest method, what we just showed you in amortization. GAAP allows for the straight line method where the difference is not material, but IFRS does not allow that. Which of the following is false? Under IFRS, current liabilities must always be presented before non-current. Well, that's true under GAAP, but under IFRS, sometimes they put non-current liabilities before. So they have a choice one way or the other. Well, that concludes our discussion about liabilities. We have one chapter left to go, and that is on stockholders' equity. Talk to you soon.